So what happened was this hedge fund was extremely leveraged, 8 to 10 times over the cash they had. Supposedly the family office has about $5 to $10 billion, give or take, and they had over 30 or maybe $50 billion of exposure. And I had never heard of a CFD, Frank. Had you heard of that? Because there's so many off-balance sheet stuff, and I know you're gonna probably go off on the 2008 rant as well. Mm-hmm. But these CFDs, contracts for differences, basically allow hedge funds to settle the gain or loss in just simply cash on a daily close. So you don't have to put up money up front. It allows you to get a lot more leverage than what you ever could with just cash. Now, that's all well and good when things are going. I started reading about this. It's all over the Wall Street Journal. It's all over every financial news site, and for good reason, because it caused a big pullback in certain stocks. I mean, Viacom and Discovery tanked. They dropped 25%,
even more than that,
in a single day on the one day.
One day.
And everybody keeps asking CNBC, what happened? There is nothing new under the sun. You got over leveraged, you got caught, and you blew up a bunch of money. And don't feel sorry for these assholes and these idiots, because they know exactly what they're doing. I do feel sorry if somebody had their money with them and, they didn't exactly know what they were doing. I don't really buy that, but don't feel sorry for this. This is just another example of over-leveraged and not paying attention to the risk that you're taking on. And I'll turn it back over to you for a good rant, because it's interesting, but it's just another story of
and it's funny,
silliness.
like these guys who open these funds and lose. For example, this is like one of the Tiger Cubs, and he was fined for insider trading and paid it and apologized. And he has like a Catholic background and believes in God and stuff like that. And I don't know if God told him to steal everybody's money or not on insider trading, whatever you want to blame it on. But and what happens? This guy just has a family office. The next thing you know, it's $10 billion, and he's leveraging it 30 to 41, $10 billion. I mean, do the math. We're talking about massive, massive leverage, which is if something little goes wrong, which you saw in the credit crisis, banks were leveraged 30 to 1. You just needed a 2-3% decline in home prices, not even. And then you're going to see the market collapse, 5%, the whole entire thing collapse, and even the good companies collapse. And then you're seeing the moral hazard where, I think it's funny that Credit Suisse and Nomura, I guess, don't have good contacts because they got nailed with this. But yet Goldman Morgan Stanley also had leverage to this. But they were negotiating with the company before Credit Suisse and Nomura knew what was going on. And then they were like, you know what? F this. These guys are done. So, they unwinded their trade, and then they said, well, here you go, you guys, here's the margin call. Boom. And these things crash. I know Goldman, I know Morgan Stanley. Just like Goldman did during the credit crisis, Daniel, the same exact thing. I know they did, but it's going to be hidden. During the credit crisis, they were betting on housing. They were doing great just like everybody else on leverage. Then they saw everything starting to collapse. And as it collapsed, they were able to keep the market steady until they unwinded all their positions. And not only did they unwind all the positions, they actually bet against the housing crisis and the housing market, and did this through insurance products through AIG. And when AIG was going to fail, that's when everything blew up because nobody was going to make money. The whole system breaks. But the fact that Goldman and Morgan Stanley had access to these guys and negotiating and talking to them and then got out of the trade, I can guarantee you that Goldman, probably Morgan Stanley, shorted the crap out of these things, knowing that what was going to happen. It was right there. They knew. They were talking to them. They were like, look, we're dead. We're these things are down. Here's a margin call. But how doesn't, what does that say for Nomura and Credit Suisse? Like, would you put your money there? Would you put it in Goldman Sachs and Morgan Stanley, who seem like, these are the guys that really knew what was going on. These other guys are just like got nailed. That's one aspect of it. The other aspect is what you mentioned, Daniel, is the leverage. This is off balance sheet. This is offshore stuff that nobody knows about. When you're looking at Reddit, and why was the Reddit crowd able to crush Melvin Capital? Because they saw their positions, which you don't have to report those positions, but they had options and they reported. But if you don't know these short positions or know where they got, like the government had no idea that these guys will leverage that much. Yeah,
I'm sure there'll be another congressional hearing soon or whatever.
Which will do nothing, right? Would do nothing. They're all getting paid by these big firms and everything. It's going to be a congressional hearing. We're going to do this, that, slap them with a couple of fines, which they all know. They generate billions in profits. Here's $10 million here. They all have a slush fund set up for these, which is great. And they all have contacts at the SEC who worked at the SEC, now work at Goldman, work at Morgan Stanley, and say, hey, this is coming down, and just to let you know, get ready. Okay, cool. We admit no guilt. Here's $2-3 million, and we're fine, right? That's it. That's the way the game's played. We all know it. But to the bigger point, this is not the only company that's leveraged like this. I mean, if you look at a hedge fund and what they're positioned to do, they're positioned to make as much money as they possibly can And risk isn't really a problem because they're using other people's money. So if they leverage and go crazy, not all hedge funds, but they leverage whatever amount. I mean, you could say, well, leverage, people create. No, leverage is a good thing. Buffett used leverage.
Yeah.
That's why Buffett is so big, because he leveraged it to the assets. That's why he bought insurance companies. He had these massive pools of money that he leveraged, and he's a great stock picker, and that worked out great for him. It's not that, hey, I bought and hold Wells Fargo and look how good. No.
And I know you're not accusing him, but
no, I'm not. I'm just saying how
his leverage was a lot less risky. Because of what he was focusing on.
It.
Absolutely.
Exactly.
Leverage is not a bad word by itself, and I know you're not saying that.
Yeah. But when I look at this and how many, if this guy's able to do this and leverage himself 30 to 41 and nobody knows about it, how many more funds are like that? Because I could tell you, when you take out Bitcoin, they're giving you like 10, 20x leverage. And these are kids. What happens when Bitcoin falls by 20, 30,000?
Bitcoin doesn't fall anymore, Frank.
But it will fall. And when it pulls back, you're going to see, I mean, the leverage is going to come out of this market. It's incredible. I mean, with all these, loans, and they have the, Bitcoin as collateral and stuff like that, which, we just talked to, which is a scary thought. Now, a company like BlockFi and some of the others are well positioned, have algorithms, they have big names. They have those safety controls on there to really, just like our company, if we don't generate a certain amount of revenue, this is what we have to cut. You always want to look at that. Good managers look at that. Like, what happens when this happens? This is what we need to do. This way you're ahead of the game. But this extends to a lot of companies where you don't even know, just like the credit crisis, where the damage is. And what caused the credit crisis? Well, we had a housing market that went up, Daniel, and we had low interest rates, relaxed laws that allowed, people who are making $60,000 to buy $700,000, $800,000 homes, 3 or 4 of them, without putting any money down. So we tried to fix that up. But what's causing it now? I mean, it's the Fed. The Fed is promoting this. It's almost like the college admissions scandal, where you have Stanford making hundreds of millions of dollars and you pay a tennis coach $50,000 a year. Of course, he's going to accept a bribe. You got to expect that, right? I mean, it's not about morals. It's about this guy is dealing with kids who are worth hundreds of millions of dollars. Every place he looks, everyone has the greatest car, the greatest boat, the greatest house in the world. This guy's making $50,000. And some guy says, you know what? I'll give you $200,000 if, or whatever. I'll donate it to 10, whatever, water polo. I mean, it almost promotes this, the way systems are set up. But the Fed, you have easy money. You have QE through the roof, pushing out money incredibly. You have super low rates. It's encouraging these guys to take on excess leverage. Yeah. And I don't know if the Fed sees this or not, because there's always consequences to what you do, just like the housing crisis happened. There's always consequences to interest rates being low and never this low in history. There's always consequences. You don't see them right away. But Dan, think about this. If we could have the market push to all-time highs, household wealth go to all-time highs, all because we have low interest rates and we continue to throw trillions in the market, why not throw 20 trillion into the market? Why not keep rates low forever for the next 50 years?
Well, they plan on it.
It's not the way the system works, right? It's going to work now until it doesn't, but this is what happens when you see these risks popping up, because people get greedy. You're using other people's money, teacher pension funds or whatever. If you lose a big deal like this idiot who got caught for insider trading, what is he doing? He raises another $10 billion, right? Which happens all the time. You see these funds blow up and they make a phone call. Next thing you know, they got another $2-3 billion. And they're going to do it all over again until they get lucky on the right play. And then they're going to have a massive, massive, massive payday.
Yeah.
But, a lot of the Fed has to take responsibility here. And they have to look at this and say, okay, let's not be idiots like we were in 2006, 7, 5, 6, and 7, when all this shit was taking place. And we just closed our eyes and didn't care about it. I mean, this is 2 funds now. Melvin Capital leveraged. And now you have this other fund that was leveraged. It's not limited to this. And this is just the past 2-3 months has happened. You're going to see a lot more of these come out. And when you have the Goldman Sachs down, you have these guys out there that when they're able to see these trades, they're sharks.
Oh, yeah.
And when you trigger someone who is 40 to 1 and you could see it, look what Reddit did with a bunch of kids with 2-3 million followers. When you have a Goldman Sachs, billionaires love seeing other billionaires get destroyed. That's the competitive nature in them. And even when it comes to big firms, you want to dominate and see other firms. If they're able to see some of these funds and the positions that they're taking, and seeing the leverage on this, they're going to do everything they can to trigger that, because they know. Look at imagine you had puts on, what was it, Discovery and Viacom and all these. I mean, you would have made an absolute fortune. Those crashed 40% in a couple of days.
Yeah, heck yeah.
It's a massive amount of money, guys. We're talking about billions of dollars to be made here, and it's just a matter of seeing what someone's doing because they have massive amount of leverage. And then once these stocks turn the wrong way, either way, whatever you bet against it, you're going to have to cover. It's forced selling or forced buying, whatever it is short covering. And that's what scares the shit out of me, to be honest with you.
Yeah. A couple of things here real quick. The Fed is not going to take responsibility.
No way.
The biggest mistake that me, Frank, every other individual investor can make, in my opinion, with the Fed is that do not think that they know what they're doing. This is the first time in financial history, thousands of years, that we've ever experimented, and I don't use that word lightly, with low interest rates for a long time, money printing, different forms of, call it whatever you want, democratic socialism, anything like that. Nobody knows the effects of what's coming because you've never been here before. And the people at the very top are not always the smartest people in the room. And I'm not trying to take shots at them because it's easy to do that. But they're either too dumb for the position they're in, which means they shouldn't be there, or they know exactly what they're doing and they continue it because it benefits a certain group of people over somebody else. Personally, I think that's why they do it, because you can't look at reality and not see the effects you have on markets, wealth inequality, and all that kind of stuff. Number two, the only thing that really upsets me about this whole blow up is that when you have all this off balance sheet stuff, you can't tell who owns what. Mm-hmm. And not to be nosy, but just like I have no problem with Buffett going to the Security Exchange Commission saying, hey, I'm going to buy XYZ stock. I'm going to buy a bunch of it over the next 2 months. Don't make me file and be a huge owner, because is it 5% or 10% you have to?
10% you have to file for owner,
you have to do
but
certain
every quarter
filings.
You have to. I mean, they don't go to the SEC.
Right.
But every quarter they have to report their holdings.
I understand that, but you can go get a buffer zone and say, hey, because of me, if we announce that I'm buying this, it's going to run up in price, and then I have to pay even more. So let me go ahead and establish my position. I'm a long-term guy. They've done that in the past, which is fine. But I wish they would. That's a different situation than what we have here, when you have no idea how much leverage he had and how much he owned and all that kind of stuff. That's the aggravating point for me. And third is individual investors. That's why we have Goldman Sachs and CRA, because they are the dirtiest, best people in the game,
it's like
and
owning,
you can't beat them. Join
Facebook. You hate them.
Yeah.
They track everything. They're going to zero privacy, but the whole world is going to advertise on that platform. Since
exactly.
they know
and Goldman Sachs is doing great for us, and they're going to continue to do great.
Facebook knows right now how this podcast is going to end.